You could buy the nicest house on the street and still end up broke. Because the biggest risks when it comes to property investing are not about bricks and mortar. They're not about the house itself necessarily. The real dangers are around timing, demand, and the market around you. Having said that though, those things I mentioned before can f you up real bad. I've learned this stuff the hard way. I had $50,000 of repairs just in year one on a property that was supposed to be the nice property on the street. I've also bought in the wrong suburbs and the wrong areas where the growth unfortunately never came. But now after helping almost 50 clients buy properties and having built a $7 million portfolio myself before the age of 33, I've actually seen what separates the safe investments from the ones that are just a ticking time bomb. If you get this part wrong, you don't just lose money, you lose years and years of compounding. So let's break down the 5 biggest risks to property investors from least to most risky, or most severe. Risk number 5, the asset-specific risk, the thing that maybe you're more aware of or privy to because you can see it. So, firstly, what do people get wrong? They obsess over the wrong things, the carpet, the paint, the finishes. Do these things matter? To a very, very small degree. Nowhere near as much as you think. I've seen people panic over building reports without context or understanding, and really just not knowing which issues are fixable versus which are actual deal breakers. I've had people that before they came to me, they ignored things like overlays, flood, fire, heritage overlays, ignore covenants where you can't build a secondary dwelling on the property and add long-term value. These things can all be silent killers. You just need to know which things are the speed bumps, right? The things that are fixable, the things that are not going to destroy your growth in the long run versus the things that are the deal breakers. Things like flood or fire overlays, things like covenants on a block, things like tenant-heavy pockets or investor-dominated markets, things like super irregular block shapes or buying in the wrong pocket of a suburb where none of the owner-occupiers want to live. So yes, a $20,000 bathroom or roof bill does hurt, but a bushfire overlay can kill your future development potential, it can hurt your insurance, it can impact valuations and your resale values. That is the stuff you need to be wary of. Enough of this chit-chat, JP. Give us some actionable advice. Well, here it is. Always do your building and pest reports. Do them with a qualified, registered building inspector, and don't overreact. They always look fucking terrible. They have a laundry list of items. It's about understanding which ones are the majors, which ones are going to kill property's growth, or which are going to be black holes of repairs and maintenance, versus which ones are just simple and fixable. You want to be budgeting at least 1.5% of the property's value for repairs and maintenance as a just in case. You're probably not going to have to use that ever, but it's always good to have it there so there are no surprises. I would also definitely factor in $5,000 to $10,000 on the way in for just minor repairs and maintenance, things that are going to be required to get the property rent ready. Of course, always check your overlays, your covenants. Make sure you have a good solicitor or conveyancer in your corner. Check the pocket of the suburb, the renter to owner ratio. Is it a tenant-dominated pocket? Is it an owner-occupier-dominated pocket? Ask yourself this one question. Can this be fixed with cash, or is it a permanent hurdle for growth? You can also grab my Before You Buy checklist. It's just a quick cheat sheet to test suburbs and assets before you decide to buy them. The link is below and you can follow along as you watch. Risk number 4, socioeconomic risk. The thing I see that people get wrong here is, yes, there is no problem buying in lower socioeconomic areas, but these areas have a much higher risk, whether it be tenant risk, the type of tenants you're going to get in there, or simply the pocket of that suburb that is considered the ugly duckling, the part where no one wants to be, can have a really big impact on your growth. You need to be more careful, much more careful, when you are playing in lower socioeconomic areas, even though there is absolutely nothing wrong with them. I personally own properties in lower socioeconomic areas because there is great value and I believe there is good long-term upside as well. I had a client that bought a property out in regional Whoop Whoop for $400,000 with a really great 6 or 6.5% yield. But the thing that they didn't look out for was the pocket of the suburb that they were buying in, the heavy oversupply of rentals in that area or in that particular suburb. And the issue then became they're sitting on a property that they haven't rented out for approximately 6 to 8 weeks. So they've started a rental campaign almost 2 months ago now, and they're yet to get any applications or a tenant. That is costing them thousands and thousands of dollars of holding costs over that period, let alone the stress to do with, hey, is my property even going to rent? Am I going to rent this damn thing, or am I going to be sitting on a property where I'm having to pay the mortgage without the assistance of the rental income, which is a freaking disaster. Not to mention the risk of when the economy dips, tenants can't pay their rent anymore, or the potential for values to plunge from $400,000 down to $350,000, $340,000 and being in a negative equity position. Ain't nobody got time for that. So where does the biggest socioeconomic risk lie? It's a combination of high crime, high unaffordability, and investor dominance. Because when markets tighten, these are the areas that unfortunately get hit first. Then you've got panic selling, you've got vacancy rates climbing, and that is a recipe for disaster. So here's what you can do. You can check the CIFA scores, that's SEIFA. It's a government-released stat on socioeconomics. There are a bunch of stats there. Check the crime data, the public housing data, and the median income data. The main thing we want here is we want to look for improving areas, not just cheap ones. Coming in at risk number 3 is supply risk. What people get wrong here is they're driving through a new suburb, they see a crane or some construction, they think, oh my God, growth. But the truth is, new doesn't mean valuable. It just means construction. It's a fugazi. I know a buyer that bought a $600,000 unit or apartment off the plan. 18 months or 2 years later, he settled on the property along with 200 other identical apartments in the suburb. Talk about oversupply. He had huge issues with bank valuations, which came in at $530,000 when he settled. Disaster. That's negative $70,000 in equity on day one. And I have dozens more of these stories of people that have sat on these apartments for years and years and years with zero or little to no growth. So remember that oversupply kills scarcity. It kills competition. And when developers outbuild demand, prices will stagnate for years. So what can you do to mitigate this? Well, you can check the DA register with council to see what upcoming developments are planned for the future. You can understand what the development pipeline looks like in that specific area. There are data points that can actually give you a percentage of the dwellings that exist in a suburb compared to future supply, to give you an indication as to what that will look like as a comparison of the existing dwellings in an area. I don't know if that made sense. If it did, good. Talk to people that are local if you know them around stock and absorption rates, like are people buying properties? Is there an oversupply? And quite simply, check real estate and domain. Check the sold section, check the for sale section, and see, does there seem to be a lot of stock that would not demand that someone would have to pay top dollar for the one that they're inspecting on the weekend? People are out there in the market on a Saturday or on a Thursday or Friday afternoon inspecting these properties. What is going to drive them to pay top dollar for that specific asset? And that is the question that you need to ask yourself. Coming in at risk number 2 is affordability risk. Now, why is this so important? What people seem to forget is that property has utility, meaning it has a reason, has a purpose. It's not just an investment like the stock market. 65% of all transactions are conducted by owner-occupiers or homeowners. These people have to actually be able to afford property in order for there to be sustained demand. We call it internal demand, the people that live, work, and play there, versus external demand, which is the investors coming in to make a buck. I see people all the time ignoring property price to income ratios. I see people going and investing in markets that might cost $850,000, $900,000, which might not seem like too much in terms of prices, but those areas are literally at the bottom of the barrel socioeconomically, which leaves you to wonder who is pumping up these prices. If the people that live there can't afford them, then is it all investor participation? And that is the danger you need to be wary of. So yes, investors will prop that up for a period of time, but eventually rates will rise. Locals won't be able to buy anymore, or probably are not buying anyway. Investors will sell because they won't be able to afford their repayments, and they're not going to sell their home. I'll tell you that much. They're selling their investments first. And prices are going to drop from 800 to 700 or 650. And then we're in trouble. Houston, we have a problem. Well, Houston, you've got a problem. I ain't doing that. So one of the biggest things I look for that I do not go anywhere near is when prices are too disconnected from local incomes, because that is the highest risk for growth to stop. And when the investors leave, you're going to be the one left holding the bag. And at that point, prices are just going to resync with what people in that area actually earn and can afford. Let me give you some actionable advice. When you are looking to buy affordable properties sub $1 million as an investment, ensure that you aim for properties that are 6 to 7 times the median income. The reason being is because this is what people will be able to comfortably afford in those areas. Now, the higher that property prices grow, of course, the less we need to pay attention to the affordability, because then we start to bring in a more wealthy dynamic into that area. But if you're buying in these affordable areas, you need to make sure to keep an eye on the income to house price ratio and look at a 6 to 7x multiple on median incomes. And make sure you're using data or cross-checking your data with valid sources like CoreLogic, the Australian Bureau of Statistics, SQM Research. These are all really good sources for property data. Lo and behold, we have arrived at risk number 1. Top of my list is market cycle risk. What people get wrong here is that they get FOMO, they look to invest in these locations that have already boomed or right almost at the tip or the top of their property cycle, or they're just sitting around waiting forever for the crash that's not never going to happen, but it's just dumb to wait around for a crash. Both of those things are going to destroy your returns, I'll tell you that much. So here's an example from a buyer, Ange, who bought in 2015 in Brisbane for $490,000 and then sold in 2020 for $560,000. So over the 5-year period, it did bugger all, 70 grand. Whereas another buyer bought in Brisbane in 2021 for $670,000, and that is now worth $1.2 million. Still a 4 to 5 year period, but vastly different results. One barely grew at all. The other doubled in value. That is the power of taking advantage of a market cycle. Yes, of course, JP properties are the long-term game. It's a long-term game. Yes, fine. But your ability to generate equity in such a short period of time in a very good, solid, stable capital growth location will greatly impact your ability to grow your portfolio and naturally your long-term result, your growth and your passive income that you want down the track. So don't listen to the people who tell you that timing doesn't matter in the market. And you've all heard the saying, it's not about timing the market, it's about time in the market. Yes, to a certain extent, but you compare two people, one who was able to time their market cycle better than the other, that person will end up millions and millions of dollars better off over a 10 to 20 year period. I guarantee it. I've done it myself. And for others. The market cycle risk is basically buying at the wrong point on the property clock, buying at 11 o'clock instead of buying at 5 o'clock. I've got clients who bought in the Melbourne market while it was still in the downturn, which is what I did for myself before I took any of my clients there, and I was able to buy property that was not only under market, but those clients are sitting on more than $100,000 of equity in 9 to 12 month period. And we're talking about $650,000, $700,000 purchase prices. That is the power of taking advantage of a market cycle, and there's plenty more growth ahead for them. I expect their properties to double in value. Don't hold me to it. I don't have a crystal ball, but I expect their properties to double in value over a 5 to 6 year period. And we're not talking about some bum nowhere location that no one's ever heard of. We're talking about solid capital city metropolitan locations. So, takeaway, don't forget, property is cyclical. It does have cycles and is a multi-speed property market, meaning what is happening in Sydney is different to Melbourne, is different to Southeast Queensland, is different to Perth and Adelaide. Some actionable advice. Avoid the markets that have seen like 30, 40% growth in the last 12, 18, 24 months. Run for the hills. That's the exact opposite of what we're looking for when it comes to timing the market appropriately. Yes, you are not going to be able to pick the bottom. That is not the point. We're just trying to make sure we're not at the top. Look for markets that are tight in supply, established low supply, that are affordable for its residents, which means it gives us good demand longevity, and that are undervalued in terms of their price point in comparison to other similar locations. And of course, focus on the data. Don't make emotional decisions based on, the Olympics this, or the infrastructure that, or the project this, or the upgrade to the highway that. Forget about it. Use the data. And use it to buy early in the cycle, but just not at the top. So in summary, those are the risks that basically can wipe out your wealth, your growth, can hinder your equity entirely. And of course, as always, if you do want some help identifying these risks in your own portfolio or on your own property investment journey, feel free to book a strategy call with moi. I'll look at your portfolio, I'll look at your numbers specifically, and we'll make a plan just for you. See ya.